Welcome, my name is Kevin Uphill. I'm the Chairman of Avondale Mergers and Acquisitions, specialist in mid-tier transactions. Today's session we're going to be looking at deal structures, both the technicalities and current trends around deal structures. Overall, we should examine what's happening in the market and the market behind those transactions. Today we face significant change in both global growth and economic growth, with a balance of trade held back and also a significant aging population. Western markets are slowing dramatically. As a consequence, we're seeing slow economic growth, and there's no material signs that that trend is going to change. In these environments, people look to mergers and acquisitions in order to add value to their companies and create shareholder value. Simply put, the more companies there are chasing the same business, the more consolidation needs to occur. This both creates threat and opportunity, but it drives mergers and acquisitions volumes, and behind that we also see an increasing change in the way deal structures are looking at. Now, to set the scene in terms of deal structures, of course, there's a myriad of different ways to approach that. Most of the transactions we do are share sales. This is dictated to by the tax regime in the UK, the first 10 million being at just 10% with entrepreneurs relief. Asset transactions we do very few of, and really only appropriate for partnerships or sole traders. So we're not going to cover the difference between those two. But in terms of sales, you've also got the difference between trade deals, i.e. selling the company to trade buyers, and or private equity, so private equity investors or overall buyouts. And that's a really important new trend. There's over £3 billion worth of private equity looking for a home in London today in the mid-tier space. So there's a significant energy in the private equity transaction market. As well as trade transactions or private equity, part of the backdrop to that is also management buyouts, management buy-ins, or indeed bought-in management buyouts. Simply put, if private equity are taking transactions or stakes, or indeed bank funding is going to look at helping a deal, the question is who's actually going to run the company? Is it the existing management team, a management team buying in, or an investor bringing in management team? Overall, a further element to the question is it a sale, a full buyout, or increasingly we're also seeing what we call elevator deals, where it's a partial exit, perhaps a reinvestment, and then further opportunity to cash in additional sums later. We'll examine all that in more detail. Before we look at deal structure, we should just remind ourselves roughly how valuations are carried out in the M&A sector today and in the mid-tier space. Of course, valuations are subjective, and all the projects we run are on offers basis which enables the market to decide. Our focus is to find transactions in the strategic value, and deal structure can be used to help ensure you get strategic value. Accountancy value is very much how the financial model dictates value, whereas strategic value is where you have the four corners of strategic mergers and acquisitions coming into play, driving the deal. We call these four corners shareholder value, synergy, economies of scale, and disruption. If a transaction brings to the buyer all four of those elements, then categorically it's a strategic acquisition. And as a consequence, the multiplier of the profits, which is a typical valuation measure used in this space, can be materially different to a financial valuation. If you look at this chart, it shows the accountancy valuation across the bottom band, shows multiples or number of years earnings across the left, and along the top vertical axis you've got profit in thousands and millions. Clearly the bigger the profits, the bigger the multiple, and the multiple bandwidth from the accountancy valuation is running from anywhere from 0 to 6 against the bigger profits, and the strategic value is running anywhere from 4 to 12, and that is where it's not just about the profits, it's about the economies of scale, synergy, shareholder value, and market disruption. So the underlying backdrop behind these values is that deal structure also impacts on it. The bigger the multiple, the higher the potential risk for the transaction. And therefore, the more likely buyers are to hedge in some way through the deal structure. That simply means de-risking. Effectively, if you pay all cash on completion, it's a high-risk transaction. What happens if anything goes wrong? So increasingly, buyers will put in, say, a deferred payment. That both helps them fund the deal, but may help them lock in the principal behind the transaction. We're doing one at the moment with a £700,000 deferred payment, £2.5 million transaction. It is a deferred payment. It's not linked to profits or gross profit, but it is subject to the owner staying and continuing to run the business over the next couple of years in order to effect a good handover. That creates a de-risk for the buyer, but it also helps them fund the potential transaction. At the same time, by not having an earn-out, it means that they can get on and do what they want to do with the business, and nobody's trying to track or restrict the cost base in order to track an earn-out. So cash, of course, is at a higher value than deferred. Deferred is an IOU, is at a higher value than an earn-out. An earn-out is where you take some of the money over a period of time subject to the performance of the business. You might, for example, structure that based on the growth of the business, or you might structure it based on the business hitting the same sort of numbers as the last couple of years. A typical earn-out should be on turnover or gross profit, ideally avoiding an EBITDA or profit-related model. The problem with profit-related earn-outs is they're very difficult to track and police, and also they create conflict between buyer and seller in terms of who's actually in control of those profits for the duration of the transaction. So simply put, if you're waiting for some of the money, depending on the performance of the business, who's in charge and controlling the performance of that business for the duration? Gross profit or turnover related to a certain extent diffuses that argument. But the earn-out is simply where some of the money is paid subject to the ongoing performance in the business. It might typically be expressed as we'll pay 50p in the pound of all gross profit achieved over the next 2 years, subject to the principals continuing to run the business. It may well be that the principals are not expected to run the business, and it's simply an earn-out on growth down to the buyer to deliver. There are a myriad of different structures. We'll look at that again in some of our examples. The final element to types of payments is shares. So you may sell out for an element of cash on completion, but get a rollover in terms of an opportunity to reinvest in the new company that's bought the business and keep a percentage of the business. The key to this, and we call them elevator transactions or rollover transactions, of course, is there are tax breaks on retaining shares, but also it's the intellectual argument, is it better to own 25% of the business, well-funded, well-invested for growth, having de-risked initially for cash out, and then work out how to make that business worth, say, 10 million, as opposed to a business that might have plateaued. So elevator transactions enable sellers to de-risk, take some initial cash out of a transaction today, capitalize on their assets, but then have an opportunity to go back in to a fast-tracking business with working in partnership with the new owners without having the full responsibility of driving that growth. Typical elevator transactions normally sit around what we call the buy, build and sell strategy. So very often the purchased entity is actually being used as an acquisition vehicle to drive overall market consolidation. And it may well be that those shares that have been rolled over or retained will also be used in an entity that actually carries out future acquisitions to consolidate the market. The key is, can you make a business that today might be worth 3, worth 10 or 15, and if you retain 15 or 20%, then clearly you can see how you get an extra yield out of a transaction through retaining those shares. We call that an elevator deal. Now clearly, if you're accepting structured payments on a transaction, and there are a myriad of different deal structures, today is a light session to give you an overview only. But one of the keys is, well, what protections do I have? What formulas are likely to be used? Now, a good mergers and acquisitions advisor won't just introduce a transaction, they will absolutely lead and navigate these nuances and key elements to all the technicalities of deal structures. If you like, a key part of our role is to translate the accounting and financial elements into English to help people understand the risks involved in it. Now, an all cash transaction theoretically has limited risk, but we've just had a transaction where somebody's been asked to give warranties for over 10 years on stock. Now, it's normal to give warranties on tax for 7 years, but most other warranties are limited for 3 years. So that materially changes the risk ratio of the deal. So whilst you may be being paid cash, a warranty is that if something's not as represented, a future claim could be made against you for the cost of that issue or risk. So, for example, if you said that there are no staff issues and you transferred the business, and then subsequently it was found out that there was a sexual discrimination case going on, a claim was made, and a claim for £1 million came in, then that would be a warranty claim against you. So if you got your 5 million on completion, for example, you may well face a clawback of some of that money. So whilst cash is king, there still remains issues around warranties and indemnities. The key way past that is to disclose. If you've got risks, it's about sharing those with the buyer in order to create a sold as seen scenario. So if you imagine it like selling a car, if you've got, for example, an intermittent problem with the windscreen wipers, disclose that, then the buyer can't make a future claim against that. He's buying it or she's buying it sold as seen. Other protections with deferred payments. So again, if we were looking at, say, a £5 million transaction, you might have 3 million or 4 million on completion and £1 million paid on a deferred payment. Increasingly, those loan notes, as they're called, might be that the payment is due in 2 or 3 years' time for that £1 million. That enables the buyer to use the company's cash flow to build up the reserve payment to make those deferred sums. Now, our view is that waiting 2 or 3 years for that significant sum of money is unacceptable, and we would like to see those transactions where any deferred sums are paid quarterly or even monthly, which creates a diminishing risk and therefore protects the seller in that transaction because they simply have more visibility on the payments. But there's all sorts of things that you can do to further protect those loan notes or deferred payments. Effectively, you're being asked to be a bank and you're actually helping finance the transaction. Increasingly, people have to do this because the banks aren't lending at the same ratios they were previously in the pre-crash arena. So loan notes might have interest yields on them. They may also have protections, for example, if there's any late payments. And again, ideally on a diminishing risk basis, the sums would be paid. But if there's any late payments, the ability to pursue and claim the whole sum might create a stick to ensure that the payment schedule is kept to. Another element that we often negotiate is that a non-compete clause falls away if there's any issues with those diminishing risk loan payments. So again, that's very useful. Not ideal for sellers looking to retire, but again, it creates a significant motivation for a buyer to stick to the payment schedule that's been agreed. And then, of course, you would put charges and guarantees on the buyer in terms of making sure that those loans are protected as you would if you were a bank. A material disadvantage of deferred payments is that you do need to declare them to the revenue and pay the tax in advance in order to secure your entrepreneur's relief. If you don't get the money, however, you can claim it back. If we look at earnouts, all of the above applies in the sense that you will look for guarantees, charges, and may also have things like the non-compete clauses falling away. But fundamentally, the sums are fluid. They're not agreed. It's against a formula rather than a specific. We're saying that it's subject to performance and it's subject to the ongoing performance of that business. And it may be on the past performance or future growth. And it's usually expressed as a percentage or pence in the pound of that future performance. And we're then back to this argument of, well, who's running it, who's in control, and or debate for the duration of that earnout. I like to break earnouts down into two elements. You've got one which I would call a performance-related pay, which is very much where the seller has a light involvement. You've got the other, which is an earn-out, where the seller is absolutely driving that growth hands-on over the next year or two in order to extract their additional money. The final element, we mentioned that some deals, or increasingly elevator deals, where people are retaining shares. And another reason for that trend is that you have entrepreneurs that are very clear that they don't actually want to give up work, and increasingly seeing that if they were in a position where they have capital, the issue of what do I then go and do, retirement not being what it used to, and people not that clear that they want to go off and have long holidays, etc. They still want to be productive and be involved. Elevator transactions actually to an extent solve that. So increasingly some sellers are embracing the concept of retaining a stake and seeing how they get on with that. But clearly we need protections, and the standard protections for minority shares occur. The golden egg when you retain shares is to get more than 25%. 25.1% takes you above being a minority. It enables you to veto special resolutions. For example, a sale or a future rights issue, shares issue, requires a special resolution. So you have that protection. If you can't get 25.1%, a quality shareholders agreement, in particular valuing the shares pro rata rather than minority discount valuations, is absolutely critical. But overall, the key to shares is understanding what the future exit strategy is and what the track record of the buyer is in actually realizing that future exit strategy. Minority shareholdings in illiquid private companies have questionable value. It is really important to assess what the future liquidity of those shares are going to be against the buyer's plan and the buyer's track record. Now here, it is easier to see this when you're dealing with private equity, because their track record is normally highly transparent, whereas with private trade companies looking to take shares, it's much harder to assess the realization of the plan and therefore assess the value of the shares being offered as part of the transaction. Let's turn this into some examples, because I'm mindful I've covered a lot of technicalities there today. A transaction we carried out to Care Fertility was a Southeast Fertility Clinic. We ran this transaction a year or so ago with a couple of doctors, Mark and Michael. They had built the clinic up, got to the point where they were making $500,000-600,000 profit, and they got very clear that their next step would be to open another clinic. And when they looked at it, went, we're not really the right people to take this business further forward. If we run another clinic, we've got more management issues, and we don't really have the buying scale or the capital to go in and set up another clinic. So they concluded they were sellers. We actually had 3 offers for the transaction and arrived at this with Care Fertility. Now, on 500k profit, they had a reasonable balance sheet. Typically a transaction would be done with a balance sheet debt-free, cash-free. So that means there's a formula there to work out if there's any surplus cash in the balance sheet. So we were selling the shares. On the 500k profit, medical sector, our forecast valuation was 3 million. We went out on an offers basis. And the transaction we ended up with gave us a headline value of 4 million. But with 2 million on completion, debt-free, cash-free. So was there any surplus cash? On this occasion, no, they'd already taken the money out. But if we'd have done the debt-free, cash-free formula, then there may have been additional to that 2 million if surplus profits were being left in the business. There was a deferred payment payable over 2 years, £1 million. And as we said earlier, it's important if you can try and make those payments quarterly. On this occasion, it was a diminishing risk with quarterly payments. Good buyer, trade buyer, private equity backed trade buyer. So we had guarantees from the corporate entity that £1 million would be paid, with a covenant that it would be paid. Both of our doctors got jobs out of it, and we're going to continue running the clinic. And as a consequence of that, we agreed their run rate, whilst their current profits were only $500,000, we were in a position where we were forecasting against the historic run rate and growth of the business, that we were going to be in a position where we were hitting 500, 550, 600, 700 EBITDA over the next 2 years. So the buyer motivated the sellers to achieve that growth whilst they retained control by agreeing the increase in value against that future profit, that future EBITDA. So we got an extra £1 million over 2 years subject to achieving all growth above a 600k profit. EBITDA, of course, earnings before interest, tax, depreciation and amortization. And a particular complexity around this transaction was tracking how do we control, when we come into the main corporate entity under their brand, the costs of the clinic. For example, do we look into the ongoing nature of marketing? Do our doctors control that, or do the corporate entity control that? And we agreed a mechanism where the costs were controlled based on the historic costs, apart from some additional management charges. That way the doctors could track and have visibility on what they were earning over those 2 years in order to have confidence in achieving their earnout. The transaction went very well. They have achieved the material element of the earnout, and both are still on salaries of 100,000 plus. So you can see how, where we had an initial valuation of 3 million, through embracing the deal structure, we were able to use an earnout structure to uplift the overall total deal value to 4 million. Another example, North Downs Vets, a specialist veterinary hospital, in some respects a simpler transaction. Again, we had 3 offers. We took 11 million in cash on day one. There was another £500,000 worth of surplus cash, so 11.5. It was a debt-free, cash-free transaction, so we got 11.5. We then took loan notes, again a deferred payment. On this occasion, it was subject to one of the principals, not both of them, one of them staying on an ongoing basis, but there was no other performance-related element to that deferred payment, so it was fixed, diminishing risk, quarterly payments again, over a couple of years. But more importantly, what our sellers then did is took some of their proceeds and reinvested it into the overall corporate equity entity that actually bought the business. And through doing that, that business, a business called Willows, which is on a buy, build and sell strategy, their target is to take a current business, if you combined it with North Downs, with a value of 25 million, up to an overall £100 million valuation through acquisitions. So our sellers effectively became key investors with a percentage in that acquisition vehicle, and they are looking to realise through that reinvestment a 3-4 times yield on that equity. Interestingly, the reinvestment, which came in the form of shares, so they took some of their 11.5 plus 2, the cash and the loan notes, and reinvested that to the tune of 1.5 million each. The pitch is that each of those 1.5 million in equity will be worth 3 or 4 million. But for the duration of 5 years, they're also getting interest on that 1.5 million at the rate of, I think it was 8%. So you can see that although we have a headline price of 13.5 on the upfront, over the whole journey of a transaction, if the overall business is sold for 100 million, then there's an actual target valuation of 18 million. Again, embracing, working with the buyer, helping the buyer de-risk the transaction through locking ourselves into the transaction, and therefore increasing overall the material value. So many people view deal structures as a potential downside to transactions. They see it as risk, and they worry about how do they track the money, how do they see it. But increasingly, if you approach the deal structure in the right way, it can actually be used to materially elevate the headline price and create a win-win between buyer and seller. It's about being transparent, it's about being blunt about the risk between the parties, and it's about having longer dialogue in the negotiation in order to navigate through those risks to make sure it works for both sides. And in consequence, the vast majority of transactions which are well thought out, that have structured deals, do actually uplift value rather than diminish value. And here's some examples of some of the other transactions we did. So a summary: such structured deals can drive value. It's important to look at what warranties, indemnities and protections you're being asked to give. Deferred payments, they are IOUs, they're next down from cash. They are a positive way to help both fund deals where banks are not in a position to assist, but also potentially with interest rate yields can be useful for sellers in order to maximize value. And they're also a useful mechanism for buyers in order to lock sellers in for a duration in order to protect the ongoing management of the business as you go. Earnouts can be a useful way to sell businesses, particularly with fast-tracking growth based on future forecasts as opposed to past performance. The old accounting maxim that valuations are based on the last 3 years' historic profits has gone. Nobody is in a position where they can remember exactly where they were 3 years ago. Increasingly, values are being done on what's happening today and what's happening tomorrow. Yesterday's profits are spent. The goodwill is tomorrow's profit. So structuring deals relating to tomorrow's profit and or performance makes sense so long as it's incredibly well protected and you have the right tracking and control measures in place. And the final element to deal structures, we've discussed this in depth, share and taking a percentage of shares is an increasing trend as sellers are looking more and more where do they put their money and how do they get a future yield from that. That requires a form of reverse due diligence and that requires high quality shareholder agreements. But if it's done right in liquid markets, i.e. companies where you can see the future liquidity of those shares as opposed to just private market, then it can be a very effective way of, again, further uplifting value. Complicated subject. I hope that gives you a real good feel for it. Thank you for listening.